Do you know that 20 to 30% of the small businesses that go to sell their business don't ever actually sell their business? Isn't that shocking? Some other really awesome facts are approximately 41% of small businesses are owned by baby boomers. So that means baby boomers, they're wanting to retire soon. I was originally going to do this on buying and selling businesses, like I said in my previous video last week when I did the RV strategies, but this one is solely going to be on selling your business. Next week I'm going to talk about buying your business because I want to try to keep these shorter. Small businesses represent 99.9% of the US businesses, contributing significantly to the economy. Like, small businesses are the backbone of the US economy. Do you currently have a small business that's family run and owned and you're thinking about passing it down to your kids? Here's the statistics on that. Only 30% of family-owned businesses successfully transition to the second generation. That's not a lot. Only 12% to the third generation and a mere 3% to the fourth generation. So if that's your plan, you might want to rethink that or make sure that your kids are fully involved and want to buy the business, right? All right, and then the last one I want to talk about real quick is private equity interest in small businesses. Since 2022, nearly 800 small businesses, particularly in the home sector, the home services sector, have been acquired by private equity firms, and that could be life-changing to them. I want to go ahead and talk to you about what we're going to be covering real quick today. So we're going to be talking about planning ahead, setting your goals and objectives, assessing a value to your business, hiring a team. You need a team in order to sell your business, doing your due diligence, having your due diligence set up for the buyer to come in, identifying buyers, and then after the sale. I also want to go ahead and tell you real quick, I have been to many conferences with Adam Coffey. So Adam Coffey has books. This one is on the private equity playbook. I highly recommend reading it. It's a super easy read. He has like 4 books out now. I have 3 of them. And then I am also in Mark J. Kohler's Main Street Certified Tax Advisor. And he has books out too that I read and suggest that you read too, but I am part of his program and I follow his program. All right, so the first thing I want to talk with you about are your goals and objectives of the sale. So if you have a small business, I actually want you to start with it in mind. When you start this business, I want you to be exit planning. I know that sounds crazy because you're just trying to get on your feet, and if I didn't read the statistic, only 66% of businesses survive the first 2 years. Only about 34% get to their 10th anniversary. So why am I talking about exit planning? Because you want to think about, do I want to pass it down to the kids? Do I want to sell it? Is this my retirement plan? A lot of small businesses, it's their retirement plan. They think that they are going to sell their business and be able to retire off of that money. And I just told you only about 20 to 30% of small businesses actually sell when they're listed. So if that's your retirement plan, you may want to rethink that, and I still highly encourage you to be investing anyways. Do not let that be your everything on your retirement. So have a clear vision. What do you need to sell the business for? What are your plans of selling the business for? So there is a net takeaway amount versus your financial goals. You really need to figure out how much you need to live off of once you sell the business. And then we can backdoor into that of what we should list it for and minus the fees and everything to be able to figure out what your net value will be when you get it. Because you're also going to have to pay taxes on it. People forget about that. And then do you have any debt to pay off? You're going to need to pay down debt, business debt, personal debt. And then most people don't realize this, but there's a couple different types of payouts. What's the timeline for your payout? You could get a lump sum payout, or you could get it in installments. Normally people ask for a down payment, maybe half or a quarter, and then they'll have the rest of it paid out monthly over a few years. And then that way they have guaranteed revenue coming in. And on your taxes, you only have to claim what you receive. So instead of say you sell your business, I don't know, for $1 million and you get it in a lump sum, you would have to pay capital gains on that $1 million minus whatever you bought it for in your basis in it. You would have to pay that all in that year. But if you have it over several years, you just pay the capital gains on what you received in that year. Okay, the next thing that you need to think about when you go to sell your business is what type of buyer do you want to have? Do you want to have a strategic buyer, a fair market value buyer, or an employee buyer? So I'm going to talk about each of those and the pros and cons of them. So a strategic buyer is typically another business that's looking to acquire your business, to enhance their own operations, eliminate competition, or expand their market value, their market reach, right? They are often willing to pay above fair market value because they see synergies that they'll make the acquisition more valuable in the long run. So some of the characteristics of this are, they're often a competitor. They could be a supplier or a business in a related industry. They are seeking to gain market share, customer base, or operation efficiencies, and they may integrate your business into their existing business. Pros. What are the pros of your strategic buyer? One, they're normally willing to pay a higher price due to their synergies. Two, it'll normally be a faster transaction because they already understand your business. And lastly, they can leverage their existing infrastructure to grow their business post-sale, right? So what are the cons? Could mean that there could be layoffs of your employees and major restructuring of the business. There might be less company culture or operations. If you are really big on your company culture, that may go away. So it depends on how important that is to you. And it could also mean more negotiations. So a fair market value buyer. So that is typically someone looking to acquire a business at its fair market value, typically based on financials, your assets, and industry standards. These are often individual entrepreneurs or financial buyers like private equity firms who see your business as an investment opportunity. So they're normally willing to pay a price based on revenue or profits and your assets. They also see your business as a standalone investment rather than a strategic add-on. And they're often looking for businesses with strong cash flow and growth potential. I'll talk about that later. I was going to tell you one of the things that Adam Coffey always tells us to look for or to make sure that your financials have, but I'll talk about that a little bit later. All right, so the pros of a fair market value buyer, they're typically straightforward sale. They're less risky of having layoffs or the culture changing because they want to buy the business. Like, those are things that they are looking at when they go to buy a business. They want to see the company culture. They want to make sure they have great employees because guess what? They don't want to work in the business. They're not looking for a W-2 job. They want to buy a business that's already in operation, that can basically run itself, that they can make profits off of. And the buyer is more likely to keep the business structure intact. Some of the cons of this may be they may not pay a premium price unless competition exists. They may be focused more on the financial performance rather than on the strategic benefit. So they are really going to be diving deep into those financials. And then they may require seller refinancing or earnouts to mitigate their risks. Okay, another type of buyer, unless you want to hand it down to the kids or have the kids buy it out, is an employee management buyout. So this is when the employees, often through probably management of your current employees and management team, they are looking to buy the business. Like, you are wanting to step out of the business and they want to keep the business going. They are already really good at what they're doing and they want to go ahead and keep the company running. So this is typically structured with a seller financing or an employee stock ownership plan. That's called an ESOP. Employees are already familiar with the operations, reducing the transition risk. And you have motivated buyers who are emotionally invested in the company. They want to see the company succeed because they're getting a paycheck from this. So they want to make sure that everything stays the way it is. They might make a few tweaks, like, hey, I'd do this differently if I were the boss. But ultimately, it's going to keep on going. So what are some of the pros of an employee management buyout? High continuity. So the business name intact with minimal disruptions. The employees are already knowledgeable and experienced in running the company, and it's an easier culture transition and customer retention because those customers are already with the employees that are working there. They already know them, they like them, they trust them. So what are some of the cons? So the employees may lack capital or to be able to finance the deal. They can also involve complex financial arrangements, as in those ESOPs, so that may be something that's complex. And then there's potential internal conflict between the people who are buying and maybe some leadership gaps. So that's just one of the things to keep in mind for you. So ultimately, when you're thinking about a buyer, which one's the right one for you? So it really depends on what you want as a seller. If you want a high price, a strategic buyer is your best bet. If you want a fair value and a straightforward transition, the fair market buyer is your best bet. If you care about the legacy and continuity of your business, selling to the employees might be the right move. So then another thing we need to do when we're going to sell the business is we need to get a valuation done. So there's different types of valuation. There's a CVA, which is a Certified Valuation Analysis. Typically, if your business is, I don't want to say on the smaller sale side, but 1 million to 10 million is smaller, that would be the valuation that you want to get done. There's an ABV, which is Accredited in Business Valuation. You will want to get this one done if you need a lot of tax and accounting help in order to get your business sold. And then there's an ASA. This is Accredited Senior Appraiser. This is if your business is at 10 million or more. This is the best one to get for you. And we'll talk more about that because basically they're the experts in that. They're going to come in and value the business to give you a realistic idea of what the business should be sold for. I want you to also think about this. I want you to have correct expectations on how long it's going to take you to buy the business or to sell your business. You can't just go ahead and list it tomorrow and expect it to sell in like a month and you're going to retire. Woohoo! Nope. You need, and this is from Adam Coffey, you need to be prepping to sell your business 3 years in advance. 3 years, because you need to get everything going the right way. You want to be able to get it for the best value that you can get it. So if you're thinking, I might want to retire in 3 years, well, now would be the time to start getting this stuff going. Once you actually list your business, it's going to take 6 to 12 months to actually get a buyer. And why I say it takes 3 years is you need to hire a team. So hiring your team, you need to get a CPA. You need to get an attorney. The attorney comes last because they're expensive. You need to get a financial advisor because what are you going to do with this money when you sell the business? Where should it go? That will be very helpful to you. And then potentially a broker. A broker is kind of like a real estate agent, but for businesses. All right, so then you need to do due diligence. And this is a due diligence that a buyer is going to come and want to buy your business. So you want to have, and I would recommend having a old style binder book of all this stuff ready to be able to give to them once they sign an NDA and a confidentiality agreement for you. So you want to have all contracts pulled, all insurance policies pulled, benefits plans for your employees, litigation documents, intellectual property. You want to have your financials. And again, I already talked about financials. Oh, the one thing I meant to tell you before, this is another thing that Adam Coffey recommends, is there's a 30, 20, 10% rule. So this is something I'll mention next week in my, if you're buying a business, what to look for on the financials. So for your financials, you want to have income statements. They normally like to look at least the last couple years, 2 to 3 years. You want to have the balance sheet for the last several years, your tax returns, and also for the income statement, this is where you want to have, this is my true one that ties to the taxes, And this is the one that it would have been if I took out all of my owner's discretionary items I run through the business, like paying Uncle Eddie who's been dead for 10 years. Like just those types of things, right? That's a joke. Okay, you also want to have your statement of cash flow. You want to have your projections for like the next couple years, up to 5 years. And that's typically for people who are trying to get a discounted cash valuation, cash flow valuation. So you want to be able to keep on projecting, like if you can show, oh, and this is another Adam Coffee thing, like get your business to be able to grow 30% every single year. So instead of the normal business going up like 10% every single year, your business is like, whoop, that is high potential for a really good buyout for you. Because those are people who are like, wow, they were able to do that, I can continue doing that, this is a really good value. And then you'll want to have your processes documented in this binder, or at least if you want to do everything electronically, make sure it's all ready to go in an electronic folder that you can send someone. But your processes include your SOPs, so this is your standard operating processes, like a manual, and then how you've streamlined your operations. If you have that in there, that means higher money. If you have really good SOPs and trainings and documents, like that's extra money to you when you're selling your business because that's something that the buyer wants. Okay, so what are you going to do once you sell your business? Like, there's so many people who don't think about this and they don't plan for this. Have something down. Have something down of what you're going to do, because if you do nothing, you're going to die. I see it happen so many times. Like, they have nothing else to keep on living for, and they retire, and then they die. So are you going to go volunteer? Are you going to do some charity work? Are you going to start up another business? A lot of times, buyers, I know this sounds really bad, but a lot of times, if you're going to sell your business, the buyer's all ready to go, and then the seller gets cold feet because they don't know what they're going to do after they sell their business. They're like, well, shoot, what am I going to do? I just better keep on doing this thing. No, have plans for afterwards. Are you going to, like, I know, I talked about this last week, I'm going to get an RV, a Sprinter van, and we're going to go tour the country. Like, that's something that we're actively looking forward to when we both retire. It might be that you're going to be moving to be closer to grandkids. It might be you're going to start traveling the world. Whatever it is, just have that in mind. Have something to look forward to, so that you actually don't stop the sale of the business when it's being sold, because that happens. All right, and then what are you going to use the proceeds for? Debt elimination. You need to get rid of the debt, and then I want you to invest. I am a big proponent on self-directing your retirement. So is Mark J. Kohler, Max Swanson, his partner. So make sure that you're investing your money to keep on earning your money. All right. Congratulations. I really hope that this gives you some insight on, if you're thinking about selling your business, what to do. Go ahead and subscribe to my YouTube channel. We post a video at least every single week on different tips. Remember, next week I'm going to talk about, if you're looking to buy a business, what you want to look for. So stay tuned for that. And if you like this, go ahead and share it and comment on it. And ultimately, if this is something that you're looking to do, go ahead and book a discovery call. We are here to help. Thank you.